Welcome to this week's episode of Coinscrum Markets. I'm Teana Baker-Taylor. Coming up, Strix Leviathan's Sadie Raney joins me to take a look at how the recent BitMEX news might impact the crypto derivatives markets. I speak with Koine's Phil Mochan and X-Margin's Vaidya about bringing clearing to the crypto markets. CryptoUk's Ian Taylor is joined by Sean Jones to dissect the EU's proposed markets and crypto assets regulation. And ByteTree's James Bennett is back to analyze this week's on-chain data in on-chain reaction. But first, let's take a look at this week's blockchain industry news. Following on from the CFTC's clampdown on BitMEX last week and the EU's proposed MiCAR regulations, the UK's regulator, the FCA, announced this week that they will ban the marketing, sale, and distribution of crypto asset derivatives to retail customers. This decision came almost 1 year following an industry-wide consultation. The regulator cited in its opinion that crypto assets have no reliable basis for valuation and are subject to abuse, financial crime, and are extremely volatile as the reason behind this decision. Not wanting to be left out of the limelight by his peers, Jay Clayton, the SEC chair, got in on the action too, when having observed in an interview that all stocks are now electronically traded, that it may very well be the case that these all become tokenized at some point in the future, pointing out that compared to opinions from 2 to 3 years ago, the promise of blockchain and DLT is now being seen in terms of the efficiencies that they bring. The stablecoin market provided some indication just why regulators might be in hot pursuit when the total market value of fiat-pegged tokens crossed the $20 billion mark this week, an almost 300% expansion on the year to date. Heading further east, following their high-profile hack a few weeks ago, and with blockchain forensics companies Keely following the coins, Singaporean exchange KuCoin have announced that they've managed to recover or freeze a total of $204 million out of the $280 million the hackers managed to drain from their coffers. And finally, in a rare show of support, 3 Chinese media outlets spun up some positive news about the performance of crypto assets when they flagged them as 2020's best performing investments. Given that such news typically needs to be sanctioned by the government, and hot on the heels of the Iranian government's green light for energy producers to mine Bitcoin, we may be about to see Bitcoin and its like start to enter the geopolitical arena. Make sure you remember to subscribe to our channel. Next up, Crypto RFQ. I'm delighted to be joined today by Sadie Raney, co-founder and COO at Strix Leviathan. Sadie, thank you so much for joining us today.
Thanks for having me.
So we're going to talk a little bit about the BitMEX news from last week. There's been a flurry of news coming out related to this. Can you give us your view on what's happening?
Sure. BitMEX is one of the, or if not the largest derivatives trading platform for cryptocurrency. And last week, there were simultaneous actions filed against them by both the Department of Justice in the United States and the Commodities Futures Trading Commission in the United States. Mm-hmm. And basically, the Department of Justice is working off the premise that BitMEX knowingly and willingly solicited U.S. investors to use their platform, and that in doing so, they became a futures commission merchant and would be subject to the Bank Secrecy Act, and therefore would have a number of different money laundering requirements that they would have to follow, and they didn't, which then leads to the second charge, which is that they not only didn't comply, but they knowingly and willingly tried to subvert those regulations. So these are both criminal charges. They're charged against 4 of the executives of BitMEX, and if convicted, each of them carries 5 years. And then on top of that, the CFTC filed civil enforcement actions against BitMEX for failure to register as a trading platform, again, based on the premise that they have US investors that they solicited and knowingly serviced. And from there's various violations of the CFTC regulations. And the penalties for that are financial and completely unknown, but very likely could be quite high.
Yeah, definitely. So how has this impacted the markets themselves? How is the market reacting to this news?
As with everything, it seems there are both bull and bear narratives popping up having to do with this. But what we're seeing reports of happening are that upwards of 50,000 BTC has now been pulled off of BitMEX, which is notionally around $500 million US. And the open futures positions are down 50% from reported high just about a month ago in early September. So on the flip side, we're also hearing reporting that there's a record number of new BTC wallets being opened. So one might think that BTC is leaving BitMEX, but people aren't leaving BTC because of this.
Yeah, I've seen a number of things on Twitter where, people are commenting that this is obviously big news, but yet, the Bitcoin price has not, been materially impacted, right?
Yeah.
So from your perspective, is this something that was unexpected?
No, it's not a surprise from our standpoint. When we started the company 3 years ago, there was very little regulation that applied to digital assets. So, some people took that to mean you could just do whatever you wanted and only worry about it when there was regulation. And we took the opposite tack along with a number of other people, and we looked at why regulations were out there, how they would apply to what we were doing, and then worked from there. We're really excited about this industry. We want to be in it for the long term, and we just knew that the rise of the regulatory regime was inevitable. I think that's actually one of the biggest issues for non-US companies is that they think that they're not based in the US, so they're not subject to US rules, but the US definitely disagrees with you if you have US customers that are using your platform or your product. And they don't even have to have regulations specifically related to what you do, such as digital assets. And we saw with the case of Satoshi Dice, which was a betting platform, online betting platform. You could bet in BTC. And at the time, there was no regulations against online gaming. There was nothing saying that Bitcoin was a security. And in 2013, at the advice of council, Satoshi Dice blocked all US IPs, but by that point, they'd already had $400 million transacted through their website. Mm-hmm. And the SEC fined them and went after them for securities violations, which leads to kind of another issue with our industry, is that regulators can double down on you. They can penalize you for not registering, but then they can also penalize you for violating the regulations that apply to the registration that you didn't get. Mm-hmm. So, and it doesn't even have to be digital asset specific. Again, they can decide that retroactively, which is really hard from our standpoint. A regulator tomorrow could decide that a specific coin is a specific thing that applies to a regulation that we've now violated, and you can be fined for trading it yesterday or last week or last year. So it's really hard. It stifles innovation in this space quite a bit.
So, Sadie, how do you think that this might impact the crypto space going forward? Do you think that other people will be deterred from either entering the space or from trying to skirt regulations going forward?
I hope it doesn't deter people from entering the space, but I do think it will deter some people that are considering skirting the regulations in similar ways. But overall, this is not going to deter people in general in the financial markets, because this isn't a new occurrence, and it's definitely not specific to crypto. Just 2 days before the BitMEX announcement, the Department of Justice and the CFTC also issued parallel actions against JP Chase and a number of their affiliates for fraudulently engaging in manipulative trading of US securities, which Morgan admitted to, and the fines for that are over $900 million US combined, and they're going to receive a 3-year deferred prosecution agreement. So that's a 200-year-old household name in traditional markets. So, I don't think it's new to crypto, and unfortunately, I think it'll just continue because the regulators are always going to regulate.
Yeah, absolutely. So you mentioned a deferred prosecution agreement. That's something that happens, quite often with banks, large companies that, some would argue are too big to fail. How do you think this BitMEX case might resolve?
The BitMEX case, well, I think that really is going to heavily depend on what BitMEX was doing behind the scenes to validate their money laundering, or to ensure that they had no money laundering happening on their platform. Having a policy that says you can't have U.S. customers is definitely not enough. And, even if you have a terms and conditions that the investor signs that says they're not a U.S. citizen, that still doesn't cover you. The regulators put the onus on the company. So it really is going to depend on what BitMEX was doing behind the scenes. But whatever happens, it's going to take a long time, I think. If the New York Attorney General case against Bitfinex is any example, they'll spend the first 2 years just arguing about jurisdiction. And then from then on, they'll have to prove what they're accusing BitMEX of doing, and that could take a number of years unless there's a smoking gun somewhere that we don't know about.
Okay. Well, Sadie, thanks so much for joining us today and providing some color and context around this story. We'll be watching it both closely, and we'll have you back in a few weeks, and we can check in again.
Great. Nice talking to you.
Nice talking to you. As regulators make their moves and the industry readies itself for institutional adoption, an unbundling of the prevailing crypto exchange model will push the market towards an architecture that institutions and regulators can get comfortable with. Koine and X-Margin are two firms looking to introduce the notion of clearing to the crypto markets. I spoke to their founders, Phil Mochan and Darshan Vaidya, this week to find out more. I'm joined this week by Darshan Vaidya, founder and CEO of X-Margin, and Phil Mochan, founder of Koine. Thanks, gentlemen, for joining me today.
Thank you.
Oh, brilliant to have you. So we're going to be talking a little bit about bringing clearing to the crypto markets. And I think just for some context, with headlines from the likes of Paul Tudor Jones and MicroStrategy on one side, through to BitMEX on the other, there's various forces that are at play in challenging the crypto trading ecosystem to mature and remodel its early infrastructure to more closely kind of mirror those of regulated traditional markets. And in traditional markets, you typically see the roles that a crypto trading venue plays, such as execution, reconciliation, custody, settlement, et cetera, performed by separate entities. And another market function in particular, prime brokerage, has gained a lot of attention this year with a number of players in the crypto space moving into that arena. But your companies are both looking to bring in the roles of clearinghouse and calculation agent. So Phil, let's start with you. From an end user's perspective, there might not appear to be a huge difference between the two, but could you explain the nuances between a prime broker and a clearinghouse, and maybe what their respective responsibilities are, the benefits that they each bring to the industry?
Yes. I mean, one of the key principles that seems to exist in traditional securities trading is the idea of separation of duties, which means that you break up the roles to avoid the risk of theft or security losses. And that's very much how the existing industry is structured and evolved, quite unlike the crypto industry, where much of the roles are mixed. And those roles in the traditional model, the prime broker is typically one of the very large investment banks that takes orders on behalf of its typically large clients and is able to provide them with credit facilities to allow them to trade, based off collateral that is provided by the custodians of that client. And that prime broker will then send orders to market execution, and then there will be a post-trade solution in place. And that post-trade solution will have a number of components to it, potentially transfer agent, a settlement house, a custodian itself. So you've got those elements, and what the clearinghouse is all about is taking the instructions much later down the timeline of the trade to create finality legally, and to ensure that payment is made for the trade that is made, whether that is done in fiat. And so there are transfers of fiat to finally settle the trade through the clearinghouses, normally on a netting basis at the end of a given period, which might be daily or less frequently, depending on each individual market.
Okay. And Darshan, can you give us a little color and explain the role of a calculation agent?
Yeah, it's a bit simpler, I guess. The calculation agent largely sits in the back end, so calculating how much margin is being used by each user in a bilateral agreement. It's in essence just assessing the risk and P&L of the counterparties, preferably in real time.
Okay. That is a bit simpler. So Phil, tell us a little bit more about Koine and the services that you provide, and what development or what stage of development is Koine in today?
Well, we are in digital financial products, predominantly at the moment in the crypto space, which is where all the action is. And what we do is provide a post-trade solution. And if we compare that post-trade solution with existing, say, securities, then what we do is we take on the complete end-to-end model of transfer agent, settlement, custodian, and registrar, and we compress all that to the same point, so that all of those elements, rather than happening over days, happen in a fraction of a second. And that's what we're doing in the crypto market, but it's got much greater applicability in the later stage towards the securities market.
Okay. And Darshan, can you tell us a little bit more about X-Margin's products and services, and specifically how your zero knowledge proof features are being received by trading venues and traditional institutional participants?
Yeah, sure. So basically X-Margin is a zero knowledge calculation agent. So instead of seeing the trades between two parties and calculating the bilateral margin, X-Margin basically takes encrypted data across all of a user's counterparties, and so is able to calculate the overall risk and portfolio margin for each user, and then essentially lock that portfolio margin in someone's wallet or custody solution. And so doing this in a zero knowledge way basically allows a user to automatically settle and trade across multiple counterparties. And what we essentially do is be able to get margin offsets to these users across all of the counterparties without needing a central clearer or regulated entity in between. So we essentially launched a successful pilot doing that, and expanding that offering now by working with lending firms to basically facilitate lower risk loans and cheaper cost of capital for trading, using the same zero knowledge risk infrastructure, in essence providing like zero knowledge credit scores for trading firms that are looking to borrow cheaper from lending firms. So in terms of how it's been received, like, I guess, frankly, like, most people don't really care about the underlying technology within the trading space as long as it does what it needs them to do. And so most of the questions we get asked about the technology are, one, is it scalable? Two, is it provably correct? And three, is it compliant from a regs perspective? And in most cases, the answer's been yes. In most use cases, it's been yes for us. So yeah, generally it's been well received. I think for exchanges, that provably correct needs more track record and time, as opposed to just some sort of cryptographic proof. And so yeah, overall, trading firms and lending firms, though, we're solving a pain point for them, like by giving them collateral efficiency and risk monitoring and privacy preservation. So for those guys, it's been well received and easy to adopt.
Okay. So these products and services are kind of designed to address and mirror, as we discussed in the beginning, traditional financial services, traditional financial markets. And many founders of trading venues that have gone on to become the successful, or the large trading venues, didn't come from traditional financial market backgrounds. So I'll ask you both, for each of your businesses, what has been the response from the industry to the services that you offer, and how much help are you getting from the demand side? For example, new participants that might have been waiting in the wings, are they now considering entering the market if these services were in place?
Maybe I can start with that one. Is that I'd say the response is bifurcated, and it's split between those that have come from a traditional capital markets background. And that's mainly on the buy side of the institutional funds, because asset allocators tend to allocate to proven managers who have a capital markets background. And those groups have found that our institutional model, which is a centralized counterparty, is echoing what they are traditionally used to, and therefore it drives capital efficiency in a way that they would like to see. On the other hand, the venues, the traditional crypto venues, which have quite different models in the most part, from traditional capital markets infrastructure players, have been more reticent to adopt that model, because they've not necessarily understood that is a requirement for institutional capital. But we are seeing an increasing take-up of that as they recognize that the decentralized model is not yet universally accepted by asset allocators.
Sure. Darshan, anything to add? And maybe I'll also ask you, how important is it that these functions are kept distinct from one another?
Yeah, I mean, I think from our perspective, we work with lending firms and trading firms predominantly, and custody solutions as well. And I think the first two tend to be, at least in my experience in the crypto market, from a traditional finance background and capital markets background, like Phil was saying. And we've, as a result, seen them to be understanding of the fact that these pain points are a bottleneck to volumes and seeing their profits grow. So generally, they're open to solutions that free up capital, and essentially, whether we go about it in a traditional way or a technological way, I've seen that most of the people from the traditional finance backgrounds tend to be open to solving more the pain points as opposed to how they're necessarily solved.
So as the crypto markets have grown in recent years, regulators have obviously taken a lot more notice as to what's going on. And, the recent events that we've seen in the last couple of weeks, such as, BitMEX, the CFTC, the European Commission has just proposed new guidelines for crypto asset regulation in Europe. And the FCA published yesterday a decision to ban crypto derivatives for retail customers. So, Darshan, how have your conversations and relationships with regulators, how have they gone? Have they been keen to support you? What kind of challenges have you had in that area, and where do you think we're going?
Yeah, I mean, obviously, it's an interesting time with all of the things that you just mentioned, and it validates some of our hypotheses from the beginning, which is that navigating the existing regulations is vital versus just running further overseas to avoid that regulation. I think navigating the existing regulations and trying to fit either to be a regulated entity that does regulated activity, or finding specific niches where you're not doing regulated activity seems like a more scalable way forward. So far we've operated within the remit of predominantly the CFTC, and our conversations with lawyers have been fairly comfortable because we're basically a technology solution where we don't touch the funds, we don't see the trades, and basically just help firms get more capital efficiency. But in terms of how keen the regulators are to support us, I mean, they tend to be very open actually to capital efficiency solutions, and especially if they tend to reduce operational and systemic risk. So for example, like trade compression is a good example of that, where whilst it's a relatively simple innovation, like it's been massively encouraged by regulators and has had significant positive impacts on like traditional finance. And our product is in that vein. We're sort of somewhere between a calculation agent and trying to do something similar to trade compression. It's just a slightly new take on both of those things. And as a result, the conversations have been generally very positive.
Great. Phil, do you have anything to add on that from Koine's perspective?
Well, I would say it's very encouraging to see the European regulators come forward with a set of policy suggestions to modify the existing regulatory frameworks across 4 or 5 different areas of regulation to provide some uniformity and consistency on the digital asset side. And it's very much along the direction that we had anticipated and had already built our systems to, for example, MiFID compliance, stablecoins using EMI structures, all of that. So we find that it's very much going in a sensible direction in the EU level. The UK is a little more uncertain and erratic in its behaviour. And I'm not sure the recent decision to ban CFDs at the retail level on crypto is a very positive one for consumer protection, given that the previous experience of doing the same for FX just moved everything offshore and gave no protection to the consumers as a consequence of that action. So I think there are certain political moves rather than what I would call common sense being applied in some cases. I don't disagree. Well, finally, we have heard some positive murmurings from the SEC last week about traditional assets starting to become digitized. So that's interesting on the other side of the pond. How would this merging of two worlds fit into your respective roadmaps? And would this move toward digitization put your companies individually in a position to steal market share from incumbents? Darshan, do you want to do this?
Yeah, sure. Basically, I think our opinion is that so much of traditional finance is still massively underserved by central clearing. There is obviously a very big centrally cleared traditional finance space, but then, for example, like bespoke bilateral derivatives, certain CFD markets, they're all like huge markets that are in the trillions of dollars per day that are still underserved by the traditional central clearing. And so there is definitely room to provide capital efficiency and automation in those markets in the ways that we're doing it and also the ways that Koine are doing it. I actually think that I don't actually believe that, I'm not overly concerned about stealing market share. I think there's lower hanging fruit than that. There are markets that, like I said, are underserved already that we could service first, and then I think the other markets will come.
Brilliant. Great. Well, gentlemen, thank you both so much for joining us today. It's been a pleasure to have you.
Thank you.
Thank you very much.
Just before the founders of crypto derivatives exchange BitMEX finding out how regulators deal with nonconformists, the European Commission published its Markets in Crypto Asset Regulation, or MiCAR. The EU intends to align the regulation of digital assets with other asset classes across all EU member states. Along with the recent FCA announcements, Sean Jones from XReg spoke with Ian Taylor, chair of the trade body CryptoUk, to review these announcements and consider what they may mean for the industry.
Okay, thank you very much for that, Teana. And now over to our next interview. I'm joined by the lovely Sean Jones of XReg Consulting. Hello, Sean.
Hello there, Ian. How are you?
I'm very well, thank you. My name's Ian Taylor. I'm the chair of CryptoUk. So today we're going to discuss the recently republished first draft of the new regulations for markets in crypto assets, also known as MiCA for short, which is proposed regulation covering the Eurozone. This recent publication follows an exhaustive public consultation, which closed in March this year, and followed 2 leaked non-papers that members of the community have seen over the last few months. We'll touch on this particular regulation as the main topic for this discussion, and then we'll also see what else is happening in the regulatory space. So if I may ask you, Sian, to give a brief introduction of yourself and the great work you do with XReg in Brussels, for example.
Well, thanks very much, Sian. I'm Sian Jones, as you know, and I'm senior partner at XReg Consulting. I spent a fair bit of time in Brussels, particularly around 2014, 15, 16, helping MEPs when they first needed to come to terms with this brave new world of what then was just virtual currencies. And here we are, with a very extensive purpose-built piece of regulation, probably the first in the world that's as comprehensive as this one.
Thank you for that, Sian. And yeah, you are the perfect person to help us navigate what, in my experience, and us at CryptoUk, we did respond to this consultation, which I must say was some 150 pages long. So let's start with the first question. What is MiCA?
Well, it is, as you said, the Markets in Crypto Assets regulation. It is a very broad and comprehensive piece of regulation that I think is bound to have a profound effect, not just in the EU, because it's an EU regulation, not just in the European Economic Area, which then includes Liechtenstein, Norway and Iceland, but I think it's going to have a profound impact really across the globe, simply by virtue of it being so comprehensive and Europe being such a large trading bloc.
Mm-hmm. So you mentioned that it's one of the largest pieces of regulation in the crypto industry. So who does this apply to then?
Well, I guess you could, at the highest level, say pretty much issuers of all manner of tokens referred to as crypto assets. So that even includes utility tokens, then goes through stable coins, both of 2 different categories. Then also beyond that into what are going to be known as crypto asset service providers. So that's a broad range of service providers, the ones you might expect, such as exchanges and custodial wallet providers, but there's also a broader range, really anybody who's running a market or anyone who is providing a service into the space is going to be caught by this legislation.
Can you sort of give us an indication as to when you believe this will be transposed into law, and then folks in the industry will have to start, obviously, adhering to the new rules?
Yeah, well, it's super important is to understand that because it's not a directive but a regulation, there's no national transposition required. So once it comes into force, it's going to be applicable across all 27 member states plus the 3 extra EEA nations. And if you think about something like AMLD 4, 5, and so on, the anti-money laundering directives, if you think about MiFID, if you like, the long-established but equivalent piece of regulation that covers really financial instruments, then there you're looking at directives that once the directive came into force, then had to be transposed into national legislation. So it was a kind of 2-stage process. This is going to be a directly applicable regulation. So I guess if you look at typical timelines, you're going to be looking at 1 to 2 years, 1 to 3 years as being quite the normal, certainly for something that is as broad and all-encompassing and wide-reaching as this, then you would expect that to take probably a couple of years to come into force. It's probably just worth adding to that, Ian, that if, because some member states already have national regulatory frameworks for crypto assets, where that's the case and folks are already licensed under those arrangements, they just melt away when MiCA comes into force. So whatever you've already done disappears. Presumably the regulators in those countries will kind of transition people across quite easily, I should imagine. But the reality is the existing laws where they exist simply disappear.
All right, so let's get more into the detail here. So you briefly mentioned what's in scope. My involvement in crypto in the last few years, we've seen a number of different taxonomies that have been released, and the general consensus is, in my view, that we have the three different categories: payment, utility, and security token. So let's just talk a wee bit about MiCA's taxonomy and how it may slightly differ.
Well, absolutely. So what MiCA does is it says that everything that is already covered typically under MiFID, so anything that is a financial instrument, still already subject to MiFID and any other appropriate legislation, that doesn't change. So if it's a security token that meets the criteria for being a financial instrument, that stays exactly the same, and you can ignore MiCA. It's just still going to be governed under the existing arrangements. But it says that everything else that's a crypto asset, within a pretty broad definition of crypto assets, basically, any kind of asset that is based around DLT, everything that we know of as a token or a coin in the crypto sphere, is going to be then caught by MiCA. And that includes utility tokens. So there are a base level of requirements that will apply even to issuers of utility tokens. And then it sets a sort of next tier up, if you want to think of it like that, as stable coins, which it defines either as asset reference tokens or e-money tokens. And if they're asset reference tokens, they'll be based on anything other than something which references a single fiat currency. Anything that references a single fiat currency, like a euro, for example, that will be deemed an e-money token. And effectively, both those categories each have separate, very specific and certainly more stringent rules applicable to them.
So
and then there's a sort
of Tether, and that would be classed as an e-money token, right?
Tether would be the different forms of Tether would be e-money tokens. Libra's proposition under the version 2 version 2 white paper, where they would be based on single fiat currencies, so they would be classed as e-money tokens, whereas say the version 1 idea of a basket of tokens, Libra's sort of version 1 concept, that would have been an asset reference token. And there's a kind of top tier. Those stable coins, which the European Banking Authority, the EBA, which is a Europe-wide regulator, an existing regulator, deems to be a significant token, so a significant asset reference token or a significant e-money token, are subject to the most stringent rules.
Sort of who's in scope, which market participants and crypto businesses that does this cover? Now, we could assume that some of our members of CryptoUk, that the larger trading exchanges have the resource to look at this, to start complying with the regulation that's coming down the pipe. But what's your view on, say, the smaller startup, maybe a wallet provider? Does it impact them, and do they have to play by the same rules as the bigger players?
Well, essentially, yes. The carve-outs are mainly for issuers of tokens who are only planning to raise less than €1 million over a 12-month period. But for service providers, it's pretty much the same across the piece. The way that it's described is essentially anyone who provides a crypto asset service by way of business is caught, and then it lists out what those services are. They include any kind of custody or administration service, so custodial wallet providers, obviously, exchanges, and that's not only crypto to fiat crypto, but also crypto to crypto exchanges, those who operate trading platforms, and then those who are involved in either placing crypto assets or involved in order execution or order reception or transmission. And possibly the other one that's pretty significant, I think, are those who give advice relating to crypto assets, but only where that advice is specific and personalized. So generalized tips, Bitcoin's going to go up next week, I think. A broadcast to everyone probably is not caught by the way it's defined in this proposal. But me saying, Ian, I think we all ought to get into sushi tomorrow, that would be a personalized and specific piece of advice. So that kind of distinction is made. But again, this is very similar to the sorts of categories that you would have found for investment firms and under MiFID. Mm-hmm. Very similar type of arrangements.
Let's move on to the other elements that we haven't touched on with this regulation. So firstly, market abuse. And unfortunately, in any nascent industry, this does occur. And we have seen a number of scams, whether it be ICO scams through to manipulation in trading volumes and pricing manipulation, for example. Does MiCA cover off the market abuse piece?
Yes, it does, and I guess it's something which market abuse piece covers really anyone who's involved in crypto assets that are admitted onto a trading platform that's operated by a CAS, by a crypto asset service provider. It covers things like disclosure of inside information, a prohibition on unlawful disclosure of inside information, for example, prohibitions on insider dealing, and prohibitions on market manipulation. So again, very similar to the kind of provisions that you'd see in traditional financial markets are now being applied to crypto markets.
Just as a final question for MiCA, and then we can touch on some of the other similar regulations going on across the globe right now. Let's talk about advertising and promotion of crypto, because we've all had emails or seen social media posts telling us that we can make 100 times an investment. What does MiCA say around companies or coins or projects promoting?
Well, there are very specific rules for issuers and what information needs to be put out. So there's a requirement for issuers of all categories to put out a white paper, and for that white paper to have certain prescribed information. For that, what I'll call the higher categories, so the stable coins, and then even higher category of significant stable coins, there are yet more stringent rules around the white papers. And indeed for all stable coins, they'll need to be effectively pre-approved, which fortunately they won't need to be for utility tokens, but they still have to be filed. And the information that's given in them has to be fair and not misleading, and you can't have ridiculous claims around that. That's going to be controlled. And the issuers and those who put out the information, in other words, are going to carry liability for that information. So that hopefully is going to provide the right kind of environment for those kind of outlandish claims that we sometimes have seen, or just irresponsible claims. Sometimes people who haven't gone out of their way to be deceptive, but just made really kind of negligent claims, not really balanced claims, and so on.
We in the industry just saw yesterday the regulator here, the FCA, has decided to ban the use of derivatives referencing crypto assets and ETNs, exchange traded notes. This was a public consultation that I worked on that closed the end of last year. I can say that let me just talk briefly about what this means to the industry. So the sale, marketing or distribution to retail customers of derivatives and ETNs that reference unregulated crypto assets, at the moment unregulated, but maybe not in a few years, will be banned in the UK from the beginning of next year. So I can tell you from my analysis that 97% of the respondents were against this. So you could argue that nobody's listening, or the flip side is the regulator will say, well, most people that respond are going to be against such a suggestion. And just the main points coming out of this review are in regards to the volatility of crypto assets and the price manipulation and valuation side to it. So I can tell you that this isn't a welcome piece from the industry. So we CryptoUk will continue to work with the folks at the FCA and Treasury to try and move forward with this, because it does seem somewhat of a disparity from what the industry were looking for.
Yeah. I think at least the institutional investors, as I read it, can still will still be able to work and invest in such products. This is really to protect retail investors that they feel are not as well equipped. So, qualifying investors, high net worths, and so on will still be able to avail themselves of this kind of product, as will institutional investors.
Okay, well, I think we've sort of run out of time here. So big thank you to you, Sian. If anybody wants to reach out to you, where can they contact you?
Well, I think it says right above my head. xreg.consulting is our website. There's you can send us a message there. You can find me on LinkedIn, Sian Jones Coinsalt, or indeed on any other channel that you care to search for me on. Whether you're in the public sector or the private sector, we work on policy and regulation, so you'll be able to find us there, and we'll happily give you the benefit of our experience and expertise.
Well, thank you, Sian. And from my side, I'm Ian Taylor, Chair of CryptoUk. You can find us at www.cryptouk.io. There's links to email addresses there. So if you have any questions for us, please reach out. That's it from us. Thanks very much. Bye-bye.
Thank you very much, Ian.
Next up, James Bennett returns for this week's on-chain reaction.
Hello and welcome back to On-Chain Reaction. I'm your host, James Bennett, the CEO of ByteTree. So, the story this week on and off the chain is really a drop in activity, or let's say a quiet period. So starting here looking at price volatility, we can see that over a 30-day period and then annualized, price volatility is at an almost all-time low of around 30%. Now, prior to that little dip that you can see in September, these are unprecedented levels of low volatility for Bitcoin at a time when there is some very serious and big news around Bitcoin going out across the world. We've seen BitMEX being reprimanded by the CFTC. We've seen the FCA banning crypto derivatives in the UK from 2021. And we've even seen John McAfee being arrested in Spain. Now, if you were around in 2017 and before that, you would know that each of these stories would have seen at least a 20% drop in the value of Bitcoin. But instead, we're here having the lowest volatility that we've ever had in Bitcoin. It's a fascinating time, and it really indicates that there's a more mature investor presence now here in this market that isn't willing to sell at the first sign of bad news. They're invested in the market, they're invested in the philosophy, and they're invested in the long-term future of this decentralized distributed network. So now moving on to the chain, we're going to have a quick look here at miner activity. So difficulty has hit another all-time high this month, which is very encouraging to see that hash rate or total compute power is increasing on the network. But miners have slightly struggled to keep up this time around. The blue line there horizontally, 10 minutes, shows the baseline of block production time. So when the blue line goes above that, you can see block times are increasing, which means miners aren't able to produce at that steady 10-minute rate. And when we drop below, it means they're ahead of that rate. So what's interesting here, looking at the different peaks and troughs, you can see the peak leads to a drop in difficulty, and then a trough leads to a rise in difficulty again. Peak, trough, and then you get right to where we are now in October. And, there's a pretty steady state, but we are a little bit above that 10-minute per block threshold. So we can expect difficulty to drop in the next period. Okay, so now moving on to transaction value. This is the amount of value that is settled on the network in dollars. And it's a similar story to volatility. We're seeing very sort of steady flow of on-chain activity. And if anything, slightly trending downwards, but really nothing huge to report here. Price is steady. On-chain transaction value is steady, if not slightly trending down. Now back onto miners here, and we can see that miners have been sending out less of those coins that they've newly minted. So recall, what we see historically is that when the market has a firm bid, miners actually sell more of their inventory. And when they're uncertain, or perhaps expecting a turn to the downside, they actually hold back on their inventory. And that's maybe a counterintuitive play, but it's just what we've seen, historically by looking at the last 10 years of data on Bitcoin. So, right now we've seen MRI drop to just a bit below 100%, and we'll keep an eye on this to see how it plays out. But miners a little bit unsure about the next move. So across the board here, we can see that volatility has dropped. We don't have it here on a chart, but velocity has dropped as well. Price is holding pretty steady, and overall, the network is looking healthy. But we're expecting a big move in the next couple of weeks. Which way? Well, you just have to follow ByteTree in order to find out. That's all from me. See you next time.
You've been watching Coinscrum Markets. Thanks for joining us. See you again next week.